It's a low-cost way to get market results, which by itself will probably beat most of the hedge fund managers. Investors buy index ETFs so that they can stop worrying about diversification, stop worrying about the day-to-day performance of their investments, and generally let an expert make the decisions. It may not be the most cost-efficient method to grow your wealth, but it is probably the easiest method out there that's available to most of the investors. And it also doesn't take much in the way of homework. Nobody will ever get criticized for telling you that the best long-term investment is a low-cost index fund. But anyone dispensing such advice is not adding any ounce of value to the conventional wisdom. Timeless advice is the lazy man's way out. At TJI, we don't regurgitate eternal principles like just buy the index and close both your eyes, or simply dollar cost average your way through because we are led to think that we should never or can never time the market. And the list goes on. You're not here to spend your time listening to us just so to be the average investor or slightly above average investor. We would rather stick our neck out by giving you specific, timely advice than play it safe with timeless but fake suggestions. Whatever we share in this channel, we have done it ourselves and we found them to be beneficial. Nothing that we do is for referrals, rebates, kickbacks, or commissions. Just the satisfaction of knowing that more people can take the shape of the trees that we planted. We know that it is not easy in this investment journey, and we have been there ourselves too. We live by a quote from Bruce Lee that tells us to be like water. In the stock market, we must be able to navigate in a manner that's highly adaptable to whatever market conditions. And we believe even more in another quote by Bruce Lee that if you love life, then don't waste time, for time is what life is made up of. We must learn how to shorten the time required to build our retirement capital, instead of just blindly following and believing that the only way to get there is to buy a home or just DCA an ETF. Or that this is the best way given the circumstances of retail investors. For every investing forum or Facebook group that you go to, you'll be sure that 95% of the investing advice are all along that line. So let us first deep dive further into the merits of index ETFs. They always preach that an index ETF is an excellent product to have in our portfolio. This is because an index ETF like SPY consists of 500 large cap companies listed on the US stock exchanges and is usually poised to go up over the long run. There is inherent bias where only the strongest companies that have shown good performance are added to the index. And in the case of US, these companies are often not only strong domestically but globally as well. The weighted components of the index can be modified or replaced if any of the existing companies do not do well in the future. This means that as long as the majority of these companies continue to do well sustainably, the value of the stocks will go up and so will the US market index as a whole. It is created by design to always have the best chance of going up. During market crashes like during COVID-19, the market as a whole has fallen to very attractive valuations. Almost every other stock is value for money, but we may not have the bandwidth to buy many cheap stocks, whether due to budget or time constraints. A simple way to get immediate exposure would to simply buy the index ETF, and you enjoy the diversification unit for different sectors in just one ETF. But there are scenarios when SPY ETF are pretty overextended and at an all-time high, where you can't find value in it. The valuations for the ETF as a whole can be overstretched. You are risking too much for too little, and that is when you need to learn how to stock pick. They may justify that holding individual stocks is too risky because anything can happen to those companies. But what they're missing out here is a risk to reward ratio. Holding a basket of diversified stocks that have mostly run up does not help to mitigate our risk as what we commonly think so. One must know when to be diversified and when to be concentrated. This is how we can pursue alpha in our portfolio that has enabled us to beat the market index most of the time. One may argue that they don't have enough time to stock pick, but the truth is that personally, we do not spend a lot of time looking at the stock market for opportunities, as long as we have a proper system to stick to. So our students in our Moneyball Investors Playbook who are new to investing and are more active, they typically spend only about 30 minutes a day looking at the stock market. And for those who are more passive, they will spend about just 30 minutes a week. And if you know what you're doing and what you're looking out for, then you don't need a lot of time. And here's the thing, once you realize how much more money you would have made, you would then feel that it is totally worth your time. Don't shortchange yourself and settle for something less. If you invest in only index ETFs like SPY with an approximate annualized return of 10%, you will only be able to grow an initial capital of 50,000 into 300,000 over 20 years. But if you stock pick and invest in good stocks that give an annualized return of 20%, the same 50,000 will grow into 1.9 million over the same period of time. Look at that difference. It is worth our every effort to learn how to invest in good stocks. Meanwhile, investors are spending time researching which ETF tracking the S&P 500 has the lowest expense ratio. It is common, for instance, to see investors asking on investing forums about whether VOO or SPY is a better buy, and content educating them about how VOO has a 0.06% lower expense ratio compared to SPY. Yes, it is true that 0.06% makes a difference. But what about the 10% difference in return if you had invested in stocks over index ETFs? I think you will agree that the 10% is definitely more worthwhile for your effort and time in comparison. We are not saying that you shouldn't invest in index ETFs at all. What we mean is that you shouldn't be limiting your choices to only index ETFs just because you are retail investors with no financial knowledge. During times when the prices of index ETFs are oversold, it is alright to take advantage of the opportunity to add some positions at a good margin of safety. But one should not be adamant and insistent that investing in index ETFs is the only best way to go for a retail investor. To quote Bruce Lee, if you love life, then don't waste time, for time is what life is made up of. Allocating some time out now to learn investing beyond just index ETFs may save you more time in the future to do things that you love in your life.